Hi everyone, in this video we're going to start working through chapter 5, which introduces a new concept in the tax formula that we've been going through, and that is itemized deductions. So up to this point in the course we've talked about adjustments for AGI, which reduce income before we calculate adjusted gross income. Now we're moving to the next step. So after we calculate AGI, taxpayers have a choice. They can either take the standard deduction or they can take itemized deductions. And they'll choose whichever one gives them the larger deduction. So in chapter 5, that's what this is all about, understanding what goes into itemized deductions and when they might be beneficial. And the first category that we're going to focus on is medical expenses. And this is one of the more detailed and sometimes confusing areas for students. So let's start with the big picture. Taxpayers can deduct medical expenses for themselves, their spouse, and their dependents. But, and this is a really important point, they can only deduct medical expenses to the extent that they exceed 7.5% of adjusted gross income, or your AGI. And this is one of the biggest concepts in this section. So it's not a dollar for dollar deduction of everything you spend on medical care. There's a threshold, and only the amount above 7.5% of AGI is deductible. So let's talk about a quick example, because this is where students usually get confused. Let's suppose a taxpayer has AGI of $100,000 and they have medical expenses of $7,000 during the year. So first thing we want to do is calculate the threshold, and that threshold, as we said, is 7.5% of AGI. Their AGI is 100,000, so we're taking the 7.5%, multiplying it by 100,000, and that gives us a threshold of 7,500. So in this case, the taxpayer's medical expenses of $7,000 do not exceed the threshold, and that means they're not going to get a deduction for medical expenses. Now, if we were to change it slightly, let's suppose that their medical expenses were $10,000 instead of $7,000. So we've got our $10,000 in medical expenses, and we subtract our threshold, which we calculated before, of $7,500, and we end up with a $2,500 deduction for medical expenses. So again, we're taking our total that we have, we're first removing the threshold, and then anything that's over that threshold is what we're allowed to take as a deduction. Now let's talk about what actually qualifies as a medical expense. In general, medical expenses include costs for diagnosis, treatment, prevention of disease, or affecting a structure or function of the body. So things like your doctor's visits, hospital care, prescriptions, medical procedures, those are generally included in medical expenses. You'll also see things like insurance premiums, qualified long-term care, and certain medical equipment are included as well. Now let's talk about what doesn't count. Here's where things start to get tricky. Not everything that is health related qualifies as a medical expense. Expenses related to general health or personal well-being are usually not deductible. And I'll give you some examples. These would be things like your gym memberships, vitamins, general or other general wellness expenses. They're typically not deductible, even though they arguably improve someone's health. And this is a really common mistake that students make. They assume that it's good for your health, so it's deductible. But the tax law draws a distinction between medical care and general health or lifestyle choices. Now, another key rule here is timing. Medical expenses are deductible only when they are paid, not when the service is performed. So if you receive medical care in December, but you don't pay the bill until January, the deduction is taken in January's tax year, not in December. So you're not entitled to take the deduction until you've actually made the payment. And this is true regardless of the taxpayer's accounting method. So here, typically your individual taxpayer is going to be on a cash method. Now let's talk about a concept that students often find confusing, and that is medical capital expenditures. So these are larger costs that improve property, for example, installing a ramp or modifying a home for accessibility or adding medical equipment to a residence. These can qualify as medical expenses, but there is a limitation. The deduction is allowed only to the extent that the cost exceeds the increase in the property's value. So what does that mean? Well, let's walk through an example to demonstrate. So suppose a taxpayer installs a medical improvement to their home and it costs $20,000. Now, when they look at, how much does that increase the value of their home by making that improvement, it increases the value of their home by $12,000. So when we talk about the portion that's going to be deductible, it's only going to be the portion above, what did not improve the value of their home. So that means we're taking the $20,000 total cost, we're subtracting out the $12,000 because that went into the value of our home, and we're left with an $8,000 deduction. So again, you can only deduct the portion that is truly related to medical need, not the part that increases the value of your property. Now, another category students often overlook is transportation costs for medical expenses or medical purposes. And these include things like cab fares, bus or train fares, mileage for a personal vehicle, and parking and tolls. So if a taxpayer drives to medical appointments, those costs may be deductible. There's also a standard mileage rate for medical travel. So you're looking at, I don't recall what it is right off the top of my head, but you're looking at keeping track of your mileage going to and from doctor's appointments, and you're applying that rate to figure out what your deduction is for medical travel. Now, the slides here also mention long-term care, and qualified long-term care expenses are treated as medical expenses, and this can include services provided in nursing homes, assisted living facilities, or in-home care. However, when it comes to insurance premiums for long-term care, the deductible amount is limited based on the taxpayer's age. So older taxpayers generally have a higher allowable deduction for those premiums. And then finally, insurance reimbursements. One important rule here, and this is again another area that students often miss, is that medical expenses must be reduced by any insurance reimbursements. So if a taxpayer incurs $10,000 of medical costs, but your insurance company pays $6,000 of that, the deductible amount is based on the $4,000 because we're just looking at what was paid out of pocket. You can only take a deduction for what the taxpayer actually paid. So if we take a step back and put all of this together, calculating the medical expense deduction, it follows a process. The first thing we want to do is add up all of our qualifying medical expenses. Once we've got that number, we want to subtract any insurance reimbursements. So this is what we incurred, but what did insurance pay for? So we're subtracting out those reimbursements from insurance. After that, we are calculating our threshold, and we said that that was 7.5% of AGI, and we're subtracting that threshold from our total expenses. And the remaining amount is what is the deductible portion. Now, one final thought before we wrap up here. Medical expenses can be significant, but because of the 7.5% threshold, many taxpayers do not end up getting a deduction unless their expenses are relatively high, as you can imagine. This is why medical deductions tend to benefit taxpayers who, of course, have large medical bills or lower income, or a combination of both. Now that brings us to the end of this video for Chapter 5. In the next video, we'll move into the second category of itemized deductions, which is state and local taxes. As always, if you have any questions, feel free to reach out. Otherwise, I'll see you in the next video. Thank you.